The tax break on debt is one of the most important ideas in finance. You've got to crack this. We've put it under bonds, but we could have equally have covered it in equities or corporate finance or company valuation or banking. It's an idea that cuts across many different areas of the financial world. Best way into this is to look at an example. We're going to look at the company that's got an EBIT of 500. Now, EBIT is earnings before interest and tax. Okay, and it's very important, EBIT, rather than looking at the pre-tax profit in this example. Now, the suppliers of capital, in one example, they're shareholders, and in the other example, they're bondholders. Both groups demand 100 this year for supplying their capital. That's the repayment or if you better than repayment, that's the compensation they require for lending the company or giving the company their capital. And the tax rate is 25%. Now let's have a look at the first example, which is equity finance. The EBIT is 500. There's no interest because there's no debt finance. So the profit before tax is 500. The tax on that profit at 25% is 125, giving us a profit after tax of 375. Now the suppliers of capital are paid a dividend in this case because they're equity holders. It's vital that you remember that the dividend payment is not a cost, it's not a charge against profits, it's a way of splitting this 375. So there's no tax benefit to the company of paying the dividend. This will leave then 375 minus the 100 dividend with a retention of 275. Now the second company has the same EBIT of 500, but here it pays interest of 100. Now what this does is reduce the profit before tax down to 400. Remember, the interest charge is a cost of doing business in the same way that paying salaries or paying for suppliers for goods are costs. So because the profit before tax is lower, the tax charge is lower. So here, the 400 profit before tax, you take 25% of that and give that to the tax authorities. That leaves you with a profit after tax of 300. Now, here is the big difference. You've already paid your suppliers of capital the 100. So your profit after tax is completely retained. There's no dividend payment. So you can see here the difference in retention for the shareholders. It was 275 and it's now 300. Nothing has happened to the profitability of the business as a business, but what we've done is employ a different capital structure where we're paying interest rather than dividend. Because interest has that tax break, you see here the difference in tax, 25 there, is actually saved by the company and now belongs to the shareholders. If you don't get this, I would watch this module again and again and again and again until the difference between Company A and Company B becomes absolutely second nature. Because as you go further into this, especially when you go into the corporate finance modules, this is a mega important idea.